Okay, so I went down the rabbit hole yesterday of tariffs versus income taxes. If you see my previous video I posted, I kind of shared my thoughts on what Trump's motivation is with these tariffs. Okay, went down the rabbit hole and I found a report thanks to Spectre Markets that shared it in their daily email this morning. And this report actually did an analysis on how much tariffs we would need to offset income taxes in the US, and there wouldn't be enough. Tariffs kind of max out at about 50%. Once you go beyond 50%, it starts to decline, the amount of tax revenue you get from tariffs. So if you assume that they max out at 50% tariffs across the board, that would equal slightly below 40% of income tax revenue in the US. So let's just say 35%. So if Trump did a 50% tariff across the board to all imports, he could reduce income taxes by roughly 35%. That's it in a nutshell. Now, there would be a lot of economic ramifications by doing this, so there's a lot of moving pieces, so it's not that simple. For example, if he put in 50% tariffs, it's going to change exports and imports, so the numbers would change. So it's not an exact science. Let's jump into what is going to happen to Canada and other countries if Trump puts in these large tariffs. What is going to happen in the economy? Okay, so large tariffs, let's just say 25% across the board and 60% for China. There's two of the figures that Trump has put in there. If that is to happen, you're going to see a quick appreciation in the US dollar. This is partially why the US dollar has been rallying lately, which is going to make US exports more expensive, which is going to reduce the amount of exports out of the US because of that. This is also going to cause depreciation in currencies like Canada, Mexico, and what that will do is import inflation into those countries. Now, it's also really going to hurt those countries' economies. So, most likely, Canada is going to keep their interest rates where they are, or maybe even cut interest rates. The bond yields are going to increase because of inflationary pressures of a depreciating currency. So you're going to see bond yields go up, fixed rates go up, variable rates go down. But what this is going to cause is the difference between US interest rates and foreign interest rates to increase. And as this interest rate differential increases, it's going to make investing in US bonds more attractive for investors. So this is going to cause the US dollar to appreciate even more. And that interest rate differential will increase. So as the US dollar appreciates even more, it's going to cause foreign countries' currencies to depreciate even farther. And this is a loop that just keeps going on and on. So in essence, it's going to hurt US exports because the US dollar is going to strengthen so much, which is going to kind of act as an offset towards Trump's objective, which is to strengthen the US economy. At the same time, it's going to cause stagflation around the world, which is not good. So what this report more or less comes to the conclusion of is that tariffs in lieu of income taxes is not good for the global economy. Short term, it's probably going to achieve some of Trump's objectives, which is giving them more leverage with regards to trade negotiations. And hopefully that's what it is, a short-term trade negotiation tactic and not a long-term economic policy, because it's bad for global economy, especially Canadians. Take care.